Managing defaulted loans is a team effort, and there are a few steps in the process. We're going to give you the full blueprint right now.
Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, thanks for checking out the show. We do appreciate it. Before we get started here, if you haven't done so already, if you are curious about the live events we have coming up in 2026, please go to hardmoneymastermind.com, click on live events, schedule a time to talk to our team, learn about everything we have coming up this year. All right, so managing defaults, there's a number of things that go into it, and a lot of them we accomplish in one monthly meeting. There's a few things we're going to look at the portfolio and make decisions, right? Make decisions on what needs to be done based on, minor delinquencies, older stuff. We're going to go through a few of the data points that we're looking at in the portfolio. One concept I want to touch on real quick is that we've always made good use of the idea of good cop, bad cop. And the good cop is going to be the loan originator, the one who brought in that deal, has a relationship with the borrower, hopefully an open line of communication. And then the bad cop is going to be me, or maybe even the attorneys that handle the foreclosure and judgment work and other stuff related to defaults.
If you're a one or two man operation and you don't want to be the bad guy and you're like, oh, well, I like all my borrowers, I'm friends with my borrowers, and I don't want to piss anybody off, then it's the attorneys, right? You can say, hey, my attorney, we're sending the file to the attorney today. If you want a payoff statement, you got to go through the attorney's office. It's out of my hands, whatever it is. Let's back up one step though and talk about when a loan is actually in default and what makes a loan become defaulted. Because what the note says and what you do in reality might differ, right? Like typically your note should protect your interests as much as possible. So for instance, if payments haven't been made, right, the loan could be in default. If the loan's over the maturity date, the loan could be in default. If the loan's over the construction agreement timeline, typically our construction agreement shows 90, 120, 180 days that they have to finish the work, and they could be in default. If you have to step in and cover costs for them, maybe they didn't make a tax payment or an insurance payment, the loan could be in default. So there's lots of different reasons a loan could be in default. And then you can choose if you want to default the loan and at what capacity do you want to default them in. So think about it like this. You have a good borrower. They do a good job on construction. They have the property on the market. Maybe it's even under contract. And let's say it's a 12-month loan and you're right at that 12-month mark and they reach out or you reach out and, say, hey, can I have some more time? The loan's over the term. Technically, the loan is in default. That doesn't necessarily mean that you need to go full court press and start foreclosing on them. That's probably not a good business move, but you do kind of have to recognize when is a good time to default a borrower and when is a good time to say, you know what, let's do an extension or let's give them a few more weeks or a few more months because they're in good standing with them. And, we want to keep a good, happy borrower when we need to.
Yeah, I mean, that's what a lot of this monthly meeting that we're about to give all the details on is about, is making the judgment calls between, is this really a default or not? Business decisions, right? It's not all exactly according to the note. Just because the note says if they're over 30 days late, that loan's a default, doesn't mean that we do that. It doesn't mean that you have to do that. Okay, so yeah, let's dive into how we run this monthly default meeting. We have one coming up later this week, so it's front of mind. A few data points that we look at. So one, I keep a spreadsheet. Of course, I'll have our loan servicing software open, and then I'll keep a spreadsheet, and I create a new tab month to month on what we're doing default-wise that month. And in the columns, there are basically in our world, it's like by office. You could also think of it by loan originator. And then going across the other way, the rows across are like default letter or start foreclosure or other, right? And so the data points that we're looking at as we go through each loan originator's portfolio, first one is late payments. So who's starting to get into, we might do starting out a quick review of actual default files, like foreclosures that are open. If there's any news like that, we'll bring it up at that time, at that monthly meeting. And then we're getting into the new stuff, like who's a little bit late. Like, for example, this is early April when we're recording this. If there are people that are due for 3/1, March 1st, so a little bit over 30 days late, most of those are not going to be default letter time. It's going to be the loan originator proactively working, communicating with their borrower and trying to get them caught up and using that good cop, bad cop language of like, look, you know, my business partners are asking about this. Is this going to be caught up? Technically, it's over 30 days, but if you get in the payment this week, we can keep you out of default. Um, the originators like Ian Walsh will be like, look, legal's asking me about this. They're going to run with it if this payment doesn't come in, that kind of thing. So right around or a little bit over that 30-day mark is probably time to heat on a little bit for the good cop to put that heat on in the right way to get those payments in. Now, if we are looking at loans that we discussed in the previous meeting and they're due for February 1st, so they're over 60 days late now, okay, now it's default letter time. Unless we have some clear exit coming up. That like we've issued a payoff statement and they have a settlement date and like, okay, we don't need to default this. It's going to be behind a month or 2 months. But it's fine. Or it's okay. Yeah, I really haven't. This guy told me he was going to make a payment. That hasn't happened. We're now just over the 60-day mark. That's default letter time. So that's one of the main data points. And that conversation right there about a number of different loans probably takes up a good chunk of the default meeting.
Yeah. Yeah. No, good point. And that's usually what most of our defaults are in. And I think if you manage this correctly inside your business, you try not to get it any worse than that. Right. Because the last
Sure.
thing you need to have, if somebody can't make their payments or they can't pay off the loan, you need to have a deeper conversation on why. And most of the time it's like, hey, listen, so and so this happened. Can you give me, 15 more days and I'll pay a little bit late. No problem. That's fine. Or I'll pay next month and then in essence they I don't know, just get a rolling 30-day. But like you have to understand the story. So number one, if they tell you something they lie about it or they don't execute on that 30 days later or several weeks later, great. Now you default them. But the worst thing that could happen is you they don't have a clear game plan and you just give them more time and then more time and then more time because you're going to be 6 months past due and nobody can catch up in that case, or it's very challenging for them to catch up
Yeah.
when it comes down to that. A common one obviously is, a borrower thinking they're going to refinance, and that's just not realistic if they're behind on payments, right? Because you're not going to be able to give them a clean payment history. The bank or the DSCR lender is going to ask for a clear payment history. You don't have a clean payment history because they're delinquent and they're past due. So it's understanding and that's why I think it's really important if you're not pulling credit inside your business to make sure you are pulling credit. Because if a borrower doesn't have good credit to begin with, they can't refinance. That's not an exit strategy, right? So, what happens if a borrower comes to you and, all of a sudden, oh yeah, I'm refinancing, I'm doing this, give me a little bit more time, I'm going to refinance, I'm going to get off your books. And then the inevitable is just going to happen at some point. So you need to fast forward and kind of educate them on the front end and save them from themselves. That you're the expert. You should know more about what could happen in this situation than they do in these. So you got to help them and be realistic on some of these things.
Yeah, so another data point that we're gonna hit during this meeting is default letters from last month. I'll be looking at the spreadsheet from the previous month. We put out default letters on this one, and this one, and this one. Have they cured? And you know what? Since our last default meeting, we've had a bunch of default letters cure. That doesn't always happen. It's more than normal recently. Like, almost every default letter that we put out has been like, "Okay, how much do I need to get this back into good standing?" Not pay off, but catch up back interest and late fees. That's typically what we'll do to get people back in good standing. They don't necessarily have to pay the legal fee yet, or if we have extension fees on there, they don't necessarily have to pay that in order to cure. That would be nice, and we might try to get it. But if they can pay the back interest and the late fees at the default rate, we'll put them back into good standing. We've had a number of these happen. Um, and that's a good situation. Like, you're going to make a little extra money on the default interest, and they're going to get back into good standing and continue with their project or their exit strategy, whatever it might be. So that's another thing that we're going to hit. Also, we're going to look at maturity dates. What has matured recently? what matured that we discussed at the last meeting? Are we doing extensions? Like, we want to keep, um, we want to, if they need more time, we want to give it to them and work out an extension agreement. We don't just want to go past the maturity date and ignore it. There's no real reason to do that. Um, you can make some extra money with extension fees and also technically keep them in good standing by not having them past that maturity date. That's another important point to hit. And then one that's overlooked that we try to be tight on is the construction balance.
Yep.
We're looking at large construction balances that maybe have been sitting there for a while. Did we fund a loan 6 months ago and there's an 80K construction job, which we have in escrow, and we haven't done a draw yet? What's going on? So once we schedule a default meeting, all of the loan originators will be looking at their portfolio, proactively reaching out to their clients and being like, hey, what's going on here? Is it permitting? Are you stalled on other jobs? Like, what's the story? Right.
Yeah, and most lenders, like, you can paint a picture of what your portfolio looks like pretty closely and know the status of a lot of stuff by analyzing some of this stuff, on a monthly basis. Are the borrowers making payments? Are they drawing from their construction? Good things happen when those happen. And if they're not drawing from construction, if they're not making monthly payments, you know that there's trouble and you got to jump in. If that's 10% of your portfolio, that's where your attention has to be spent on those particular troubled deals to make sure that that happens. I'll give you an example of something recently. In one of our other offices, it was a very large construction holdback, and the woman's been making payments regularly. Uh, it's been a year. We looked at the maturity date, and the maturity date was April, so it was this month. And we're like, "What do you want to do in this situation?" They haven't taken a construction draw out. Got on the phone with them because they're making monthly payments, no big deal. But this is the first time we actually had talked to them. Maybe we talked to them 6 months ago, but we talked to them again now. And they're like, "Well, I'm finally about to get the permits in place. I haven't been able to get the permits." No, I'm sorry. They haven't got the permits in place, but they're still working to get the permits in place. Sorry. I
Right.
apologize. I'm confusing files. And we're like, "Well, what do you want to do? Should we default this person? Should we just have them making monthly payments?" Like, they're making monthly payments on something that they're not even doing any work on. So it was one of those deals that we're like, you know what? We don't want to encourage a default and push a default if we don't need to, but they should have some sort of game plan in place. And they claim that within a few more months they should get the permits. It was a refinance. It was a low LTV refinance on a property that they owned free and clear, so it was pretty simple to begin with. But the point is we made a business decision that we're going to continue to have them make monthly payments, but like, we want to encourage folks to be in a good situation. Like, we don't want people to default. We want to, if it were in a perfect world, we'd rather have 100% perfect performance and keep it moving, keep that money going in and out to the next deal, to the next deal, to the next deal, to the next deal. So we want to encourage them to, be in the right situation. And the right situation for this particular person might be, hey, refinance into a bank loan, maybe sell the property as is. There's still a lot of equity in this property. Like, this is still a major build. It's going to take you a lot of time. Hard money rates can eat up equity very, very, very quickly if borrowers can't execute. So we want to make sure we're helping in that capacity. But even with 250 loans on our books, we have a really good overview of what's going on inside the entire portfolio by just one default meeting every month and kind of going through the problem child deals and figuring out what we're going to do. And sometimes it's just like, hey, they're 1 month back. They said they're going to make payments. Let's give it another month and we'll circle back then and see what happens. And then maybe that next month they're current. Maybe that next month is, hey, they ghosted us. And then it's default letter, full steam ahead. And at some point in your defaults, with enough, because like, you have to do the default letters, you have to file foreclosure notices. And the reason why is, even if, you believe these people are honest people and you want to stick up for them, there needs to be some sort of urgency. And there's no urgency unless you go through the process. Because what ends up happening is, as you go through this process of legal agreements and default letters and file foreclosures and notices, they realize the urgency, and they'll, even if they're embarrassed, they'll pick up the phone or they'll get a hold of you or they'll figure out a way to rectify the problem.
Yeah. So those are a couple important notes, the things that you mentioned there. Like, one, yes, the purpose of this default meeting, a lot of it is to try to keep people out of default. right? Being proactive with our portfolio and try to keep people performing if we can. But at the same time, if somebody's not getting back to you or if they're just giving you the runaround, you need to move quickly with that default letter and then shortly after that move into foreclosure because the people who are the best at telling you a story and giving you reasons to like back off are the people who are used to defaulting on loans. Like they know their game. They know what to say to get the lender to back off. Um, so like it's a balance, right? It's a balance on how you handle this. I mean, we're actively managing this loan portfolio of, in our case, 250 loans. Like if your primary residence mortgage at Chase, for example, and they have a million mortgages outstanding, if you're 30 days late, they're not going to give you a call to see what's going on. It just automatically goes to default, just like a credit card or any other kind of like bank loan would, right? If you're past the terms of the loan agreement, it just rolls into default through software. It's not a person's decision. And that's the difference between that kind of business and ours. Um, so yeah, I mean, it's interesting how we deal with this. We've definitely learned from experience and what you mentioned a couple times about like move quickly if you think you're going to have a real default situation, especially related to incomplete construction jobs. Incomplete construction jobs is where we have risk as lenders. We don't have ARV problems. If the property's on the market, for 500 and we have a 350 loan, it's in default. It's like, we're fine. No big deal. Like meter's going to run, interest is going to accrue. We're going to get paid off. If that property is not done, we have to be worried about our collateral, our value, and getting our money back. It's really those situations where you have to pull the trigger quickly because you don't know what's going on in the rest of a real estate investor's business. If they have another 5 or 7 deals they're working on that you did not fund, and you could probably find some information online, about what they own, but like you don't really know the status of these projects, right? So moving quickly in a default situation towards like a corrective result is how a professional lender handles their stuff. Some of the people that we talk to that come to us for advice in the mastermind group, if they haven't been through too many of these, it's really common for them to be giving way too much rope, way too much leeway to a borrower in default
Mm.
in not pulling the trigger quick enough. And that puts money at risk, you know?
Yeah, agreed. I mean, this is just talking from experience and going through them, and we're dealing with defaults every day, and that doesn't mean that, this is one thing that we tell our business partners and our loan originators and ourselves sometimes. It doesn't matter how good you write a deal, eventually deals will default. So we encourage our we encourage our loan officers not to bring in deals that we know are going to default. Even if they're super low LTV deals, they're gonna be headaches because we're gonna have plenty on our books that were underwritten perfectly that we would still do the exact same way again if that deal came back around, that are gonna default for unforeseen circumstances. That just shit happens. Things happen. So let those be the one to default and don't encourage deals in your books that you know are gonna be just trouble. So we've just learned this from experience, and we've gone through a lot of different default situations, and if you've been through a default before, you know that it's challenging, and if you have, a system and a process in place to manage them, just stick to the system. Be like, "This is what we do on day 30. This is what we do on day 60. This is what we do on day 90." And I get that there's sob stories and there's one-off situations, and that's okay. You know, we are in states that the foreclosure process and the default process does take time. So, like, just Friday, talked to somebody, and I told him, I was like, "Listen, like, my hands are tied at this point. Like, you've been giving me the runaround for too long. I can't do it." And they're like, "Well, we need a little bit more time." I'm like, "The property is gonna I'm not gonna I'm not filing foreclosure today and getting foreclosed on the next day. You have time, but I have to follow the process." And that in turn gives them the urgency to know, like, okay, they're serious. I still have time, but I got to move quickly. And that's what it's about. Urgency. Like we need to create urgency to get these loans cured. And if that's what it takes, that's what it takes.
Yeah, a couple more quick notes that hopefully give you some shortcuts in this process. One, I don't know if you know about this one yet that Ryan's been using. Ryan, one of our loan originator partners who is playing good cop, and he's a good guy, so he plays like a real good cop. When he's getting too much pushback, once I've already stepped in as a bad cop and he's getting too much pushback, um, he'll tell the borrower, like, I don't have access to the file anymore because it's a default, and kind of shut down that good cop avenue of communication because they're just peppering him too much and badgering him a little too much about getting back in good standing with, with no payment. Um, one note there, and then another one, having proper reporting from loan servicing software is huge in the default process because it is very, very common for borrowers who are in default to dispute the payoff statement, the amount that they owe. In their opinion, they owe a different amount, less. They they don't owe this many payments, they aren't that far behind. And when you put a loan history report right next to the payoff statement and send them both, it shuts down 99% of questions. It might maybe even 100. When you have proper software putting out a report of everything that happened during the life of this loan, they're like, "Okay, they clearly have proper data. I don't. I don't keep those records as a borrower, as a real estate investor, so I'm not gonna win this one." So, like, having proper reporting, whether you're using software like Lender or TMO, whatever it might be, goes a long, long way. The kind of stuff that you can't really produce from spreadsheets and QuickBooks and stuff like that. Not to mention it becomes really helpful if you get into court, and anyway, that's another conversation, but hopefully that is all helpful. Thank you for listening or watching this podcast. We really appreciate it, and we would be really excited to work with everyone eventually. All of the podcast listeners and watchers and all the feedback we get, we totally appreciate it. Be really excited to work with everyone in person sometime. In order to look into that, go check out hardmoneymastermind.com. Click on live events. We hope to see you in person, and we will see you here next time on the podcast.
Thank you for joining us on this Private Lenders Podcast episode. Please note that opinions stated by all the speakers on this show are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, financial, and accounting professionals. If you enjoyed this episode of the Private Lenders Podcast, we would appreciate it if you could spread the word. Make sure to check out hardmoneymastermind.com, the #1 community for all private and hard money lenders.